So this is part number 32 of this multi-part video series for positional stock traders. This is again a very important video because in this video, I want to convey an important message to you, which is that just because Market Smith marks a base on the chart with the green line, and just because Market Smith draws the pivot point on the chart with the green dotted line, does not mean that you have to take the trade. You first have to qualify the trade. Remember our orange trading system. First, we do filtering, then we do shortlisting, then we do stock selection. For stock selection, we use five kinds of analysis: liquidity, comparative, technical, fundamental, and market analysis, and in that particular order. Now, in this stock, if you see this nice base developing here, so let me quickly draw the buying range and the stop loss range. I will not draw the uh, selling range here, and I will explain to you why. Okay. So in this case, the handle is not yet completed. So the Market Smith marked this as a cup, okay, without the handle, and the high of this candle was considered to be the pivot point. So this is 256. So let's do that quickly. So I will write here 256, and then I have a calculator here. I always keep this manual, old school calculator. See, I am not a programmer. A lot of my students are programmers and they do automation and things like that. But I am an old school guy. This is a old school Casio calculator. So 256 multiplied by 1.05, 268.80, 268.80. And by the way, a lot of my students have sent me Pine script. They have taken my system, automated the whole thing, and they have sent me Pine script of the software of the indicators that they have created to spot all this that I draw. Okay. I appreciate that very much. I understand that students are liking this content very much and they are converting this into a system. However, one point I would like to mention here is you have to rely on human instinct. You have to rely on your judgment. You can use indicators and software for qualifying stocks. But once you've qualified a particular stock, then you have to visually determine whether that stock is worth your time and money or not. Your experience visually, when you see the base, you should understand whether the base is a good base or a bad base or a medium quality base. Okay. But, anyways, that's my old school style of trading stocks. Now let's draw the stop loss range. Very crude method I use. So 256 multiplied by 0.92, 235.52. This is 235.52. And this is 256. 256 right here multiplied by 0.95, 243.2, 243.2. Let's give it red color. So that's the stop loss range. Okay. Now, remember what I said earlier. Just because Market Smith draws a base and a pivot point does not mean that you have to take the trade. Okay. Now, in this base, there are a lot of things working in favor of this base. Okay. And there are some things which are not in favor of this base. Let me explain that. If you look at the red bars, okay, remember what I had told you. Whenever there are red bars inside the base, preferably they should be low volume. See, 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. All are low volume down closing weeks, which means what? Institutions are not selling. Correct? And look at this high volume pullback. Okay. Comes down, high volume pullback. Right? Very, very important. Moreover, remember we had spoken about a statement written in William O'Neill's book. The statement was constructive price pattern have tight price areas, and tight price areas have two components. One component is tight closing. Second component is small spread. The spread is the distance between the high and the low of the bar. Look at the tight closing here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 consecutive tight closings. Okay, closing in a very, very tight range. These two are almost the similar closing prices. Plus, you look at these two candles, very, very tight closing. Plus, there are bars here with smaller spreads, here small spread, here small spread. So, majority of the candles or almost half of the bars are small spread plus tight closings inside the. This is what is working in favor of this base. What is not working in favor of the base is that the stock has shot up like from 100 rupees, like 107 to 244. The stock has gone up 100% in how many months? From, let's say, May month till November. So May, June, July, August, September, October, November. 6 months the stock has shot up 100%. Okay. And by the way, this is old chart as per SEBI regulations. We have to use old charts for our analysis. So in 6 months, the stock has doubled, which means it is probably extended in price. Tell me, after this breakout, after the stock came out of this, see this long base, this looks like a proper VCP setup on a weekly time frame chart. Okay. VCP on a weekly time frame chart. Look at this after this breakout or this breakout. Tell me one bar after which you have three consecutive bars which have closed down below the high. This is the only bar. After this bar, you have one, two, three. Three bars which are entirely below the high of this bar. So, which means the stock has doubled in 6 months without taking a break. That's a negative point for that stock. That increases the risk of the stock. Apart from that, okay, first you have to qualify whether this is a positional trade or not. What is the difference between swing and positional? Well, in swing trading, we give less weightage to fundamentals. I am not saying we don't give any weightage, we give less weightage to fundamentals. In positional trading, we give more weightage to fundamentals. In fact, positional trading is about fundamentals. Okay, now have a look at this. So I have downloaded this and I have pasted this here. So this is the week of 28th of November. Okay. That means December 2023 quarter is not yet complete, which means we have the quarterly results of September 2023. So you look at September 2023 here. Look at what is the EPS growth, minus 22%. Previous 1%, previous minus 42%. So last 3 quarters, there is no acceleration in EPS growth. Plus, this number should have been more than 40%, 40. It is minus 22%. Forget about accelerate, forget about growth in EPS. The EPS has actually declined. Similarly, look at this 4% sales growth, minus 17%, 2%. So neither the EPS growth nor the sales growth is accelerating for the past 3 quarters. Neither the EPS growth is more than 40%, nor is the sales growth more than 25%, which is our requirement. So, out of the 4 criteria, none of the criteria has been in our favor. There are total 12 criteria, remember, out of which these 4 are the crucial ones, the earnings growth and the sales growth. None of these 4 are in our favor, which means what? This is not a positional trade. Of course, the remaining 8 we could check, they could be in our favor, but this is the most important criteria, right? We do check return on equity, margins, all-time highs, quarterly EPS, annual EPS, but this is the most important thing, right? If this is not in our favor, there is risk involved in the stock. I am not saying don't buy the stock. I am saying you are taking unnecessary risk. Knowing the fact that there is EPS growth of minus 22%, would you take this trade as a positional trade? Absolutely not. Okay. And you will see how this manifests on the chart. Instead of the stock, instead of going to the selling zone, it comes in the stop loss zone. Okay. So this is not a positional trade. So just because on Market Smith, you will see the green dotted line, on Market Smith, you will see the blue zone and the stop loss zone and the pivot point, green dotted line, and things like that. But on Market Smith, you will also see this. So you have to take a decision. So the important message of this video is, if the stock doesn't qualify, it doesn't make sense to even look at the chart. Okay. Look what happens. I will move forward. This is Monday, Tuesday. So the stock enters that blue zone. Look at the volume. The volume is 721,000, almost half of average weekly volume. So in 2 days, the volume has already gone beyond half of average weekly volume, which means the week is likely to close on high volume. Plus, the price has entered the blue zone. Obviously, you will think of buying, right? That's it. Look at this. The volume has already reached the blue line. Price is already trading closed inside the blue zone on Wednesday. That's a buy signal, right? Obviously, you will end up buying there. But remember what I had told you, stock selection. If the stock doesn't meet your basic fundamental criteria, it's not worth your time, even if it is completing a pattern. Okay. So technical and fundamental. Look at this. Thursdays, price continues to go up. Volume already crossed the blue line, but then it comes back. Okay. Now look what happens. I will move it forward. See, already entered the stop loss zone. Okay. Which means you must have taken out, at least you must have sold at least half of your shares. Here, I think you must have bought by Thursday, you must have bought around 80 shares, like 80% of your the position that you plan to buy. So out of 80, let's say you plan to buy 100, you end up buying 80. Out of 80, you would end up selling 40 here, right? And then it hits your 8% stop loss. That's it, you're done. Okay. Why did this happen? This happened because of the poor fundamentals, right? Probably because of the poor fundamentals. I have seen stocks go up even with poor fundamentals, but in general, if we see if a stock is not doing well fundamentally, chances are very high that it will either not go up, or it will go up slow, or it will hit your stop loss as quickly as possible. Okay. So if I have to recap this, see, let's go to Monday. Monday, you will not buy anything. Okay. But you will keep an eye on volume, good volume. Tuesday, you will buy 50 shares. If you plan to buy 100, you will buy 50 because there is good volume coming in. Price is entering the blue zone. You would end up buying 50. Wednesday, you would buy another 30 because volume is good. Price closing inside the blue zone. Then again, Thursday, you would buy another 20 because volume is already crossed the blue line. Price closing inside the blue zone. Good sign. So by Thursday, I think you would complete your purchase of 100 shares. Then Friday, the stock pulls back sharply. Okay. Nothing to worry about because the price is still inside uh, the the price is still above the stop loss range. One word of caution. Remember in William O'Neill's book, How to Make Money in Stocks, fourth edition, chapter number 11, page number 261, he writes that winning stocks usually don't fall more than 8% below the correct pivot buy point. And he also says that in fact, winning stocks don't close below the pivot point. This week, it has closed below the pivot point, right? Which means what? We have to reduce our position size on Friday, just 5 minutes before the market close. So out of 100, you might end up selling 50 shares before Friday closes. Then next week, Monday, again goes back, but you would not buy it again. Okay. Then it comes into your stop loss zone. Thus, out of the remaining shares, out of the remaining 50, you will might end up selling 25 more shares. So first you bought 100, then you sold 50, then you sold another 25 because you don't want to book an 8% stop loss. Then it again pulls back up. You wouldn't buy again. You still have 25 shares. And then it continues to collapse. Okay. The remaining 25 shares go out with your stop loss being hit. So that is how the trade execution will actually play out. Okay. If you're losing money on a stock, you don't add more shares uh, to the position size. When in this week on Friday, when the stock bounced back, you could have bought back more shares. But no, fundamentally weak stock. You have already lost money. Why to take another more risk by buying more? If you had bought more shares, or if you had bought back the shares that you sold, you would have lost money on that too. So remember, when you're losing money on a stock, don't buy more shares. Okay. Just see whether the remaining shares are making money first. Okay. Then when the stock goes up, forms another base, you could try to increase your position size. Okay. So the moral of this story is that just because we have a chart and a pivot point and the buying range and the stop loss range and the selling range doesn't mean that you have to buy. Just because the stock has got good volume profile doesn't mean you have to buy. You have to look at other risk factors as well. Fundamentals were weak. The stock ran up like 100% in 6 months in spite of weak fundamentals. So there is something wrong with the stock, correct? You have to stay away from such situations. It's better to stay away from such situations. I'm not saying this stock can't go up. All I'm saying is that there is more risk in such situations, so better to stay away. And even if you buy, go in with a small position size because you never know what is going to happen. And by the way, this is positional uh, trading on weekly chart, so it doesn't even qualify as a positional trade because the fundamentals are so weak. So remember, chart comes last. First comes filtering, shortlisting, selection. Okay, once you are through with that, only then you would scrutinize or investigate more about the chart. So I hope you got the message. Okay, if you buy this stock and if you end up making money on the stock, that's a professional mistake. Even if you make money, that's a professional mistake. Okay, I'm going to create an entire video series on professional traders' mistakes. Okay, I think probably after this series ends, I will try to create that series as well with a few videos there. What are the mistakes that professional traders do? Just because you're making money on a stock does not mean that you took a right decision. You might have bought the wrong stock and you would have luckily made money on the stock, but that's a professional mistake. I define that as a professional trader's mistake. Okay. And we will discuss that later. But you notice here, if you read Mark Minervini's book, look at this nice VCP developing here 1, 2, 3, 4, 5, 6, 7, 8. Nice breakout. In these 2 weeks, if you had bought the stock, you made good money there. So, classic VCP type of a pattern. Someone like Mark Minervini would have definitely considered this type of a stock for trading, right? But since we are looking at the weekly, uh, pay attention. Look at the tight closing prices. That is what I like about this base, but I don't like the fundamentals of the stock. Okay. Thank you so much.